The cryptocurrency market has witnessed the emergence of new trading platforms in the past few years, but not all of these platforms operate under the same principles. Maybe you have no idea what crypto trading platforms are. These are platforms that permit the interchange of a digital currency for another or exchanging of digital currency for fiat currency. It is estimated that there are more than 295 million crypto users, while crypto platforms are more than 500. Note that if some platform goes bankrupt, then how about the customer's assets? Coinbase and Celsius will be our points of reference when digesting this hot topic, so watch and listen closely. These platforms mostly operate much like a bank, which means they take customers' deposits and lend them out or make risky gambles on decentralized finance products to generate high yields. When the system is working correctly, the platform notifies customers that they can expect approval for their withdrawals within 24 hours. But if cryptocurrency prices continue to fall, customers will become pessimistic and therefore they will start to withdraw at a rate that the platform cannot handle. What makes banks different from these platforms is that banks are insured by insurance corporation, while crypto platforms like Celsius lack the legal protections that are built into the traditional financial system. Now, let's dive deep for you to get it clearer. On June 12th, the Celsius platform astonished customers when it unexpectedly announced that it was pausing all withdrawals, swaps and transfers between accounts due to extreme market conditions. Then the company decided to hire restructuring lawyers to advise on possible solutions for its mounting financial problems. Then they came up with an option of financial restructuring, which means that the company could potentially file for bankruptcy. The same to Coinbase. It addressed bankruptcy in its quarterly report and added a disclosure based on Securities and Exchange Commission (SEC) accounting guidelines released in the early days. Then Coinbase CEO Brian Armstrong came out and said that the likelihood of the company going bankrupt is extremely low and the company is in very good financial conditions, but he made the disclosure just for the purpose of transparency. Also, Coinbase made the disclosure that in the event of bankruptcy, the digital assets that Coinbase holds for its customers may not really belong to the customers. So by considering the bankruptcy of those two different platforms, you discover what actions they take to handle the downfall. Most likely they rely on their terms of use. Here is the clarification of that. Listen closely. An expert, Besikov, says exchanges will often pool different customers' crypto and funds together in the same storage wallet or account. What happens to customers' funds in bankruptcy cases will depend a lot on the company's user agreement and how used its assets. In other bankruptcy scenarios, customers may be less in trouble according to the conditions explained by the managing director at consulting Berkeley Research Group. Dustin Palmer says, in general, most customers in cryptocurrency exchanges are unsecured creditors, so when an exchange collapses, creditors are paid back first along with legal fees. Customers will be paid last on a pro rata basis. Customers will likely have to wait till the full bankruptcy process is complete before receiving remuneration, and bankruptcy usually lasts years. Now, what are the terms of the Celsius platform when it goes into bankruptcy? Celsius's terms of use states that any funds deposited with the firm may not be recoverable in the event of bankruptcy. By considering those terms, the firm filed for protection, revealing a $1.2 billion hole in its balance sheet and owing users around $4.7 billion. On top of that, Celsius claims to have $167 million in cash on hand, but it's still not letting customers withdraw their funds and hasn't offered clarity on when it will reopen withdrawals. Generally, as an investor, to protect your crypto assets, you can opt to move your cryptos into non-custodial wallets where you're fully responsible for your private key, a secret password required for gaining access to a crypto wallet. The associated risk with this move is that if you lose your private keys, you may never be able to recover your funds. Moreover, if you opt out for decentralized exchanges, it is important to read the terms and conditions to discover all the risks. What is your favorite non-custodial platform? Share it with me in the comment section below. Do you think Bitcoin will crumble at the 21 million limit? Click on the tab and we'll see you inside the Metaverse.